Good afternoon, all traders at all levels. My name is Jeff Killian. I am the Chief Market Strategist and the founder of the Vector Traders Consortium. Today, the Vector Traders Consortium is pleased to present, in conjunction with the Inside Technician, one more weekly webinar presentation to all serious traders. The primary market that we trade is ES, and the near contract month we are trading is 9/2015. Instead of getting right into the primary market, on this particular presentation, I'd like to talk about the benchmark for the US marketplace. The benchmark meaning that outside of the Dow Industrial Average, most people truly believe that the S&P 500 equities, aka known as the cash side, is really the benchmark to refer to the current state of the US economy, a barometer which takes the temperature of what is the current state of health of the US economy. So when we look at the equities, for example, today's down close at 2114.15, we want to take a hard look at what are the real possibilities for gaining some intelligence out of this market, the sister market to our primary, that can help us make a better trading decision, especially at market turning points. We discussed this many times along the way that any trader who's been around the block, even for a short period of time, would be hard pressed to say that they're not looking at the market turning points to make the most amount of money in the shortest period of time. A confirmed market point from a chart pattern perspective, as I blow the chart up a little bit here so you can see it more clearly, will be when we have one more official down close. Now that's based on the price chart pattern in isolation. We already have a pivot point high at this point here, which was created in isolation from these three bars right here. And we'll get it even a little closer here so you can see it. We have this bar, the center bar, and the down close. Now these are drawn from the dates 7/17, 7/20, for Monday's action, Tuesday the 21st, and these three bars, once again, hammering out a pivot point high, suggest that prices should continue to trade to the downside if the indicators are leading in that direction. Now that is the true value of any indicator, again, leading the price movement. In this case, the stochastics and momentum index, as we reference the relative comparison of this indicator to the price chart pattern, had lost momentum after a long run from the time period way back on 7/10 all the way until this area at 7/20. So a loss of momentum and a pivot point high established. In isolation, possibilities of the market turning back around. What we do know is that the basic rule behind a confirmed change in direction in trend based on the price chart pattern in isolation must be 3 down closes. We don't have that. We have 2. So we are one step closer because of today's down close in order to be able to say officially, if tomorrow's down close is a done deal, that we do have a confirmed market turning point, again, based on the price chart pattern. Now, what will more than likely happen if prices close down tomorrow is that the SMI will cross from above to below. The obvious loss in momentum that we just covered, and as we blow the chart up, a downtick off of yesterday's action because of the down close today, puts the disparity, aka the divided difference between the stochastics indicator and the momentum line itself, one step closer. So disparity tightens up, and once again tomorrow, if prices close down, that will be the official confirmation of both the crossing of the SMI from above to below and the third close down for the market turning point now complete. This is what we want, confirmation. Whether we have that on the Dow, whether we have that on the futures, is something that needs to be referenced apart from this. This is an independent piece of analysis to gain as much intelligence as is humanly possible as if this is the only thing you had to trade off of. And if it was, what would you do? You'd go with what is factual and actual, and you would bank on what you're looking at because it is objective analysis versus subjective. Now, if we fly in a data box here and we look at the current values, the two values in the bottom, parameterized values that are attached to this special indicator, the SMI's value on any given day, for example, here on the down close, outside of the volume figures, okay, for 721 in the data box clearly show that the SMI was at 73 and 32. Now that's below the overbought zone at 80. So we have a failed try to get back to 80, indicating weakness as compared to this level of the indicator where it did reach 80. Flying out the data box, let's look at the relative comparison, in this case, of this price versus the most recent price. Flying in a horizontal trend line here, it's clear to see that the highest open or close at this juncture was hammered out by 5/21/2015, 1600 hours equities market close. The price on the open was 21, 25, and 55. That's 21, 21, and 55. The price on the close, where the data point is attached to, is 21, 30, and 82. So 21, 30, and 82. I don't see prices at this point hitting 21, 30, and 82. So we have a failed try on the indicator to reach the same level that was achieved back here, the precise data point on the indicator that's located at this price juncture. So just by flying in the data box here and pulling out the crosshairs to make the relative comparison once again here, we can see that the indicator's value on this day was 79.6, right here, 79.6, and on this day, right here, 73.32. Hammered out, hammered out. A failed try, a failed try. In isolation, the findings that we have just come up with clearly indicate the higher possibilities that the market would have traded down today as well. This is the way that a professional needs to view the market. Now, as you look at the actual prices themselves, higher price, lower price, higher indicator level, lower indicator level, we don't have an official negative divergence, so to speak. But we do have and we'll take the price point out of here so we can focus in on the subject matter at this time and what we want you to see. Is that for nothing else, a negative avergence where the indicator is averging to the downside the same way the prices are as well. So what we just have successfully done is identified, one, the loss in momentum here out of the indicator, the relative comparison of its level to the past, an official negative avergence, right? We have identified the relative comparison of these two levels to the prices and confirmed that we have a positive confirmation to the downside based on these relative comparison areas, and that the prices should move to the downside. Now remember, people, this was yesterday, and this is today. The Stochastics and Momentum Index I use every single day in my daily market analysis because it is, outside of the EMAs, the fastest indicator within this trading methodologies toolbox. And as we look at what's really important here, it is identifying when and where the market turning points are confirmed using this indicator in isolation first. Once we get through the money flow analysis, the volume is compared to the money flow indicators. And what's the reality behind that volume? It is accumulation distribution. Are we net neutral? What is the case? We need to get right to taking a look at the SMI, because we want to hit these market turning points running. We do not want to be late. It may not be exactly the time to be short when your analysis is, for example, here in this case, the down move. But today, the down move was caught by the BTC, by myself and Alex Felix, trading live this morning because of the very bias that I had extracted based on this, plus the money flow indicators. Now, for the sake of continuing with the current subject matter, before we finish this session, I want to make it clear that anytime we're going to be trading, and we're serious about that, the market turning points must be the focus first. The confirmations that the trend has officially changed to the downside in isolation will be the cross, again, from above to below. Does everybody understand the majority of what I have explained so far? Can I get a raise of hands? Okay, good. Good. So let's go to work here and let's look at a few things that we need to identify with. And that would be any pivot point, high, low, any area where we have the possibilities for a market turning point, right? Very simple, straightforward technique. Now, I prefer to trade short than long on any given session, so I'm always looking for the short move because I know the prices usually fall faster than they move up. Some of that has changed lately because of the manipulation in the market. You know, as you look at the sell-off here, price turned right back around and steamrolled up here. But look at the size of the move here, the velocity, the rate of change, right, of the move, the accelerated move to the downside here, the accelerated day down here. So looking at what's happening here right now, as soon as the cross comes from above to below, okay, this market turning point outside of the price chart pattern, which is just about there right now, will be complete according to the relative comparison of the SMI to the prices. Here you can see the indicator cross from below to above when prices hammered out a new low area here based on this bar's close that was going back to 7/8/2015 at 1600 hours on equities close, right? You got through resistance here out of basically a market net neutral chart pattern based on this price and this low, a channel here and here, right? Higher volatility, but free and clear out of net neutral after the cross took place. That's the key, after the cross took place, and continued uninterrupted momentum to the upside being free and clear. Look at the gap up, strength in the market, and the market exhausts at or near the all-time high prices. So here's your turning point here on the cross, on the price chart pattern. Here's your cross from above to below. Here's another cross back up, back down, back up, back down, back up, seesaws, and then back up here again. The case evidence that is presented in this very short presentation is more than enough to empower any trader at any level to take a very hard look at how to nail these market turning points. Because this is the most important aspect behind trading as a professional. When these prices turn, especially on increased volume, which has not yet come in, any significant volume has not yet come in, even on market close today, and a recorded volume, that will power the prices to the downside. So if there is going to be a correction to the downside, which is in play right now, then that surely means that the first thing that will need to happen is that the prices will need one more down close, and above that, the indicator will have to cross from above to below, and guess what? The prices will need to get through this bar's open. And then after that happens, the second thing that they'll need to do is to get through the noise and confusion that exists between that level and this bar's close. Because after that's over with, we basically have a free and clear move based on the most recent prices taking precedence for the current session's trading on the way down or subsequent days from here to here. Now that may not look like a lot of points, but if you subtract the closing price of 7/14/2015, excuse me, the open price at 20.99 and 72 from the closing price of the following day on 7/15 at 2:107.40, that, my fellow traders, is a lot of points. And that can constitute one single session, two, possibly three-leg move on the primary market to the downside, because although these levels will not be exactly the same numerically on the ES futures, the relative comparison of everything that we have just done, especially the levels, will provide the initial, basic yes, but initial intelligence that a professional will need in order to gauge whether he should or she should be getting geared up to trade short and be trading the minimal amount of contracts compared to their account sizing. My name is Jeff Killian, and it's my pleasure to present to the world today. We have more people in this room today than we have ever had. There is over 38 people in this room today. So this is something about what we're doing here, and I'm proud to be behind it. The Vector Traders Consortium provides the training, course material, and the education for the sophisticated retail trader and the proprietary trader in training for financial institutions that you'd be hard-pressed to find at any price, anywhere available today. If this is your real interest and you are a serious person, then you can contact us through the Inside Technicians website relative to the Executive Mentorship Program. So once again, where we stand today leads to the possibilities of where we will be trading tomorrow. My best to all of you on the rest of the week's trading, next week as well, and we look forward to the next presentation.